How? With the change in the monetary policy. With the change in the monetary policy. If I change the monetary policy, and specifically if I change policy rates, because it will have a direct impact. When I say policy rates, it means repo rates, because repo rates play a very important role, a direct impact, a fast impact on the economy. Now, with the help of, if I increase that, if the central bank of any country increases the repo rate, then automatically the market rate, the borrowing rate, which is being given by commercial bank to people, that will also increase. And once that will increase, my dear friends, it will minimize, asset prices will come down. Now, why asset prices will come down? Because, there are two thoughts in that why the asset prices will come down. The first thought process is, asset price is nothing but the total of present value of future cash flows. It means if I buy a asset, how much future cash flows I will be getting if I total it, and then I can say that this is the value of asset. But if there is an increase in the interest rate, these cash flows will be discounted at a higher rate. And when they will be discounted at a higher rate, the value of future cash flows will come down. And when value of future cash flow come down, it is but natural that asset price will come down. You getting my point? So journey starts from here. Monetary policy. Whenever there is a case of monetary policy, I change policy rates. Then with the help of policy rates, if I increase the repo rate, due to that borrowing cost will increase. Due to that, asset prices will decrease. Now there are two schools of thought why asset price decrease. The first school of thought I have told you, that due to this there will be a decrease in the asset price. The second will be, because there is an increase in borrowing rate, no one will borrow. It means there will be less investment. When there will be less investment, there will be less GDP. So automatically the asset price will come down, less demand will be there. And when asset price will come down, when asset price will come down, I will say that these are the four channels. The first is repo rate, then second is borrowing rate, then third is asset price, and then automatically with the asset price decreases, the market will come down, and when the market will come down, automatically the expectations, future expectations in regard to growth, that will also come down. And when future expectations come down, you know foreign money will be domestic money, no doubt. People are not having domestic money, domestic currency, but foreign money will be injected in this, because interest rates in actually are more. And if interest rates are more, then foreign money will come in, and when foreign money will come in, it will increase the demand for INR, because they have to get it exchanged. When INR demand will increase, it will increase the appreciation rate. It will appreciate my Indian currency, and when my Indian currency appreciates, imports will become cheaper, and net exports will decline, and ultimately my inflation will decline. I will be telling you in detail all these channels. I have just given you an idea that in today's lecture I will be dealing with this. So let's start with the journey. The point number one, you have to firstly write down monetary. Today I will be doing with monetary transmission mechanism. These are the three words which are very important. Monetary transmission mechanism. Monetary transmission mechanism. Monetary transmission mechanism. Monetary transmission mechanism. It means I will be doing that how, with the help of change in any of the factors, that is monetary policy tools. If I change, specifically if I change policy rates, and within policy if I change repo rates, how with the help of change in that there will be a change in the transmission mechanism. So monetary transmission mechanism refers to the ways in which change in monetary policy, that is policy rates, affects the price level and inflation. Very important case study, very important point, very important learning outcome. So you should be put 100% attention in understanding that how this will happen, that how a change in policy rate will ultimately can affect the inflation rate. So I'm starting with the journey. There are four channels. Through which we will be having the tour, which with which a change in the policy rates, the monetary authority control are directly transmitted to prices. It means, firstly, I will be, no doubt, I am starting here that I will be increasing my policy rates, I will be increasing my repo rates. Ultimately, prices will come down. Now, what are the channels in between that? So, we will be discussing those channels. That channel process is named as monetary transmission process. Monetary policy transmission process, and the four channels are short-term rates. The first channel will be short-term rates. We will be increasing repo rates or we will be decreasing repo rates. So asset value will increase on the basis of that. So I am assuming that if I increase the repo rate, if central bank increases the repo rate, ultimately the asset prices will come down, ultimately the current expectations will come down, and ultimately the current exchange rate as per domestic currency will appreciate, and currency exchange rate will improve, imports will become cheaper, GDP will come down, and at last inflation will come down. So let us see the flow chart which I have prepared for you. I did a hard work. So my request to you will be, prepare this flow chart so that we can understand what these channels are. And following is a flow chart of monetary transmission mechanism. This is a flow chart. No doubt I have prepared the PPT even for this, but firstly prepare it by hand. This is the process, this is the flow chart which gives me monetary transmission mechanism, that how monetary policies changes can affect the prices. So first is, if there is an increase in repo rate, if I say increase in policy rates, if there is an increase in policy rates, then market rate will increase, because when central bank will be giving at a higher rate to the commercial banks, then commercial bank will lend at a higher rate, and it means market rate will increase. And when market rate will increase, I have just told you there are two scenarios in that. Asset price will increase, asset price will decrease. Now, why asset price will decrease? Because if I am discounting, because asset price is nothing but the present value of future cash flows. And when future cash flows are discounted at a higher discounting rate, their value will come down. When their value will come down, automatically asset price will come down. Another thought process is that whenever interest rate will increase, borrowing rate will increase, people will be less motivated in having borrowings. It means there will be less investment. It means there will be less consumption, and hence there will be less demand. So I can say asset price will decrease. So this is dependent on this. All channels are they are interdependent, they are interrelated, they are not independent, rather they are dependent. So first scenario is market, there will be change in the repo rate. Then first effect will be, there will be a change in the market interest rate, there will be a decrease in the asset price, and whenever there is a decrease in the asset price, the expectations of future growth will decrease. Expectation of future growth will decrease, and whenever expectation of future growth will decrease, no one will invest, and when no one will invest, ultimately exchange rate will will become will increase. Now, why increase? Because foreign money will be injected in India. Because if I am taking an example of India, if interest rates are being increased, it means if you want to borrow from a commercial bank, you have to pay huge interest. So foreign money will come in. When foreign money will come in, they will change their dollars with INR. Demand of money will increase. When demand of money will increase, this INR will appreciate. When this INR will appreciate, imports will become cheaper and exports will become costlier, and ultimately exchange rate will increase. And then these are the four channels which I am talking of. And after these effect of these four channels, domestic demand will reduce, net external demand will also decrease, and inflation rate will also decrease. My dear friend, I have prepared the PPT even for this. Just see the PPT I have prepared for you. So my request to you will be that please prepare with your hands that what is this monetary process, monetary policy transmission. So monetary policy, I have written increase in official interest rates. That is increase in repo rates. With the help of this, there will be four channels, and they are all dependent on each other. They are not independent, rather they are dependent. So first change will be in the market interest rate. That market interest rate will increase. Asset price fall as discount rate for future cash flows will increase. Growth expectation will decrease. Exchange rate appreciate because foreign investors might want to invest, and the effect of these four channels will be domestic demand will decrease, net external demand will decrease, and inflation rate will decrease. So please prepare it. I am giving you time, my dear friends. So I am doing monetary policy mechanism process, that how with the change in the monetary policy you can affect the inflation. So here I am in fourth point, that if central bank increases, I have given the explanation for that how monetary mechanism works. If central bank increases the official interest rate, that is repo rate, that is policy rate, that is the rate at which central bank will give the loan to banks. If that rate is being increased, commercial bank will automatically, they will increase their own lending rate. In that case, there will be a tight liquidity in the market, and interest costs will increase, and people will not be motivated in having borrowings, so there will be less investment. So second point, then it will increase the market interest rates. It is but natural, it is consequent to this. If this is there, then this will be there. It will not, it will increase the market interest rate, and when market interest rate will increase, the asset price will decrease. Now, why asset price decrease? There are two thought process. First thought is, asset price will decrease as value of asset is present value of future cash flows. My dear friends, I have told you in the valuation that if I want to value any asset, then the value of that asset will be the present value, the total of present value of future cash flows. So if I total them, I can calculate the present value of the asset. Now, because this interest rate has increased, so discounting rate has increased, so denominator is more. When denominator is more, then present value of future cash inflow will come down. When future value, when present value of future cash flows will come down, ultimately asset price will come down. So thought one, asset prices will decrease as value of asset is present value of future cash flows. Now, due to increase in market interest rates, discount rate will be higher, so valuation will come down. Or the second thought, that why there is a decrease in the asset price due to increase in the interest rates, borrowing cost will increase, and less borrowings, less consumption, so prices of assets will decrease. It is also but natural, intuitive. So the point is, there is an increase in the policy rate, due to that interest rate increases, due to that asset prices decreases, and due to that increase in borrowing cost, less will be the borrowing, so less investments, so lower growth expectations. So the third channel is, there will be lower growth expectations. When people are not borrowing, they are not investing, there is no consumption, ultimately the money will not be there, and hence there will be less consumption, and hence less future expectation, growth expectation will be also very low. And when these future expectations will be low, exchange rate will appreciate. Now, why exchange rate will appreciate? This is the important point to be kept into mind, that when interest rates are increasing, the foreign people, foreign companies, foreign investors, they will be motivated in investing into India. And when they will be motivated to invest in India, they will be bringing their foreign currency, they will be bringing euros, they will be bringing dollars along with them, and they will be getting exchange with INR. So demand of INR will increase, so appreciation will be there in INR. When appreciation will be there in INR, imports will decrease, the import cost will decrease. So please write down, exchange rate will appreciate. As due to increase in market interest rates, foreign money will come, and INR, supposing I am taking the example of India, INR, domestic currency rate will appreciate due to high demand. Due to high demand, domestic currency will appreciate, and demand of INR, and domestic demand will reduce. Now, when domestic demand will reduce, as INR, domestic currency appreciate, means export will decrease and import will increase. The import cost, import of the goods, the import cost will come down, because Indian rupee has increased, the value has increased, there is an appreciation. Now iPhone will not be so much costlier as it was earlier. Now Sony TV will not be so much costlier as it was earlier, because INR has appreciated. So the last point, which is very important, is it will all affect in, there will be reduction in inflation rate. My dear friends, in today's lecture we have discussed that how with the change in the monetary policy, with the change in any of the one of the factor of monetary policy, there will be a change in the inflation. It means earlier we have talked about first step and the last step, but in this today's lecture we have talked about the processes, that when this will be there, which process will be channelized, then which process will be affected, then which process will be affected, then at last this will be affected. So this whole process is aimed as monetary transformation process. Hope you have enjoyed it. So let's see, Gol Baba, about what are the different monetary policies which are there. RBI likely to change its monetary policy from neutral to cautious. It means a year ago, the Reserve Bank of India had shifted to this. It means there are changes in the monetary policy, and due to that changes, there will be the changes in the inflation rate and in the prices. So in this, the cautious they have decreased to this. So I think you can go through with this side. So hope you have enjoyed this. Today I have told you how monetary transmission process will work, and these are the four channels which are very important. The first channel is short-term interest rate will change. And second is asset prices will decrease. Third is expectation will decrease, and the fourth is exchange rate will increase. So ultimately, it will affect the inflation rate, and it will have an impact on the prices, and prices will come down, and vice versa for if we decrease the repo rate. Be happy, be jolly.